Hello, everybody. My name is True Demon, and I'm the Devil's Stockbroker. Well, today was a huge day in the market, spurred on by a massive move in the combined tech and finance sector. The entire SPY has moved up by a combined 2.5%. So the whole market has moved up tremendously in the last trading session to start off our third week of October, and this was something that I was very conflicted on in my most recent coverage that I conducted with the Hell's Trading Floor groups. And I gotta say, like I was leaning bullish the entire time, but I was really torn as to whether or not it would turn out favorably. Um, the move that we got today was absolutely massive. So across all sectors, um, mainly between tech and finance, the SPY moved up massively, and as you can see from the change in the account balance for the paper trading account, all of the major long trades in tech sector, and especially directly on the SPY, went massively in profit. All long positions with one exception of a short in DRV, and the entire portfolio is just completely turned around after the losses that we experienced on the first rip to the upside that we had on this daily candle. So what I'm going to do in this video is to update everybody on what happened and why the market moved the way that it did, what we can expect for the following weeks, and will we get another flush in the near term for the market going into the end of October. So as far as the catalysts go for why the market moved the way that it did, our biggest catalyst that we have for global news has been the UK bond market and the British pound. So both the bond market in the United Kingdom, also known as the gilts market, made a slight recovery, along with the British pound that gave a confidence to the UK market. That initial crash that was sustained back in October, when all of those bonds started to crash, was part of what caused us to drop so massively, or excuse me, September, in the end of September. Now, the Bank of England pivoted on that decision to continue tightening by offering to buy up bonds at any price. Basically, it's the same as quantitative easing, but it was specifically to protect the bond market in England in order to prop up their pension funds. Public pension funds provide retirement income for all public services and anybody that's in a government position long into their twilight years. So pension funds, which were literally a 15 trillion US dollar market that needed to be held up, the Bank of England offered to do that for a limited period of time. Now, when the UK market got started trading early this morning, far before the United States markets opened up, the bond buying deadline had already expired on Friday. So everybody was waiting with bated breath what was going to happen here. And everybody was expecting that since the Bank of England was no longer buying up the bonds, that it was going to cause a flash crash. And when that didn't happen throughout the early trading session in Australia, New Zealand, and the Shanghai, Hong Kong markets, the reaction in the United Kingdom was buy, 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 buy. So they bought back a bunch of the bonds, and it gave a huge swell to both the bonds and the British pound. This translated directly into a big drop in the US dollar. It was slowly strengthening throughout the day, but early this morning, it took a nosedive, man. Like right there at the beginning of the market, it was collapsing. And this is honestly something that's good for the stock market, and in the long term, it's better for our inflation numbers because it creates some distance between our US dollar being a ideal investment, which is it's part of the inflationary cause that's been hampering our market this entire time, but it's also adding some strength to the British pound, which is something that they needed because their markets were being oversold and they were collapsing. So this gave a huge boost of confidence to the market to see the dollar relax and calm down after a huge bull run over the past over the past several weeks. Like we've been ripping all year long, especially since especially since July. Like things started getting really crazy after well, actually, like more like March. So since March, the dollar's been just absolutely surging. So this drop was healthy for the dollar. This doesn't mean that we're out of the woods yet, and it definitely doesn't mean that a much larger crash is not coming after this. But for the time being, this is a big signal to us that we have a temporary market bottom and that we are witnessing the beginnings of a rally. So these types of bear market rallies are extremely aggressive, and it brings a lot of attention into the market. A lot of money flows back into stocks because the speculation that it could be the bottom, and we don't know, like this could be it, like this might be the market bottom. I think that that's naive to think that we could come out of such a terrible economic downturn so quickly. I think that that's really overly optimistic to believe that, but in the temporary, there is some opportunity here in order to take advantage of it. So even if you stayed out of the market, which if you were confused about things and if you weren't sure how the market was going to go, this was your confirmation that you should have been waiting on the sidelines for, and it was a good thing. Like this move that happened is a fantastic move, but ultimately, waiting on the sidelines is far better waiting for confirmation than taking a gamble. In my case, I threw a bunch of bullish bets onto my paper trading account, and just to prove that I'm not completely full of it. If you go all the way down to the bottom of my history, here was my last big trade. I had a hedge with SPXU, and I had some bullish bets for the SPY, and all of these closed in deep profit. So let's see, I had a very large, a $5,000 profit on my SPY, which was set up at a take profit of around, I believe it was around $367, $368, if I remember correctly. I'm trying to go back and look at this after the fact. I just barely hit my take profit at. It was at 367 actually. 367 was my take profit level. So that got hit perfectly, and this is essentially confirmed a bottom for me in the market. There's a couple of indicators that I was using in order to spot this. Some you've seen me use before, but there's another one that I'll bet that is a little bit new to you that can help with the technicals, and I noticed a signal that I am now using in order to confirm market tops and market bottoms. So something that I am going to be showing a lot more of in the future in my videos as we start to reach the peak and troughs of our trends and looking for those big reversals. So in this case, we had a huge opportunity. In my case, it worked out really great, and I know it worked out really great for a lot of Hell's trading floor. So let's get into it. So on the technicals, we see that we've had several signs that the market was very near to a bottom. One of the biggest symptoms of it was on this price cloud oscillator. This is the PCO by Peaceful Lizard. I absolutely love this indicator. And shout out to Tempestuous Persephone from the Discord, who actually went out and found this and pointed it out. It's been immensely successful, and I strongly recommend this over a standard MACD, just for the simple addition that this price cloud gives you a excellent picture when things are starting to near the bottom. So on the SPY, I was noticing a couple of trends, and one of the big signs that the market is nearing its bottom is that whenever the market touches outside of this price cloud, like such as we had back here in January, the market hits a initial bottom and then has a brief rally and then sinks down again. And this is a very short period of time, so you would be forgiven for not catching this trade. But there is consistently a deeper bottom that follows between 15 and 30 days later. And it would seem that this is only the first of two bottoms whenever it touches outside of the price cloud. And what seems to happen is the MACD moves down, it comes back up, and it goes down one more time. And you'll notice that this creates a higher low. a higher low on the price cloud indicator, but a lower low on the price. So this is a consistent signal across things like the MACD and the RSI indicators that this is bullish divergence. But what helps is that the price cloud indicator gives you an excellent barometer for when the take profit is, because the price cloud will let you know, hey, this is at like the very outer band of its potential move, and it's really overextended at this point. So when you have it touch at or just outside the edge of that price cloud, that's when you know, hey, we're getting close to a bottom and we're probably due for a rally right now. So one exact case of this is we had this move right here. We had a touch outside and then we had another dip down. And this was a perfect example where the market had hit a bottom. And we had a very large rally and a diamond top pattern that honestly you would have to trade this entirely on your own in order to see this pattern. But the diamond top pattern played out perfectly and the MACD headed down for another low, and we established yet another higher low when it turned around. So this was in fact another market bottom. And this indicator was absolutely instrumental to finding this last bottom. Here we have another case where we have touched just outside the price cloud, and then all of a sudden we started to rip back up to the upside, and then we drop back down to the downside. In both of these cases, the MACD created a higher low. So we had higher lows on the slow and the fast line. And if I zoom way in on this, you'll see that the trend was very clear. We were moving back up, and even though the price had dipped down lower, this is when you say to yourself, okay, the technicals have turned and are showing that momentum is shifting to the other direction. You also have the advantage of confirming this with the RSI, which also was showing bullish divergences in these cases, both of these cases actually. You had bullish divergence in this particular move, and this one was a little bit lagging. You actually had a downward slope here, but bullish divergence on this move right here, where the RSI was slightly higher on its low, but the price had declined to a lower low. It would seem to me that the MACD was, although it's a more lagging indicator, was a better indication of when the bottom came in. And even if you didn't catch the initial rally, you should have caught the bottom just right. And then waiting for that confirmation move back to the upside should be enough to convince you, okay, it's time to take a trade in the opposite direction, and it's time to go back the other way. And the market does this. It jukes people out really convincingly. It's really consistent about it. But learning how to find these zones is very important. And thankfully, even though we had like a really unexpected slam dunk move where the price it gapped down on Thursday and shot up throughout the rest of the day on Friday, then turned back around for a 50% retracement the following day, you can't be faulted for not being able to perfectly trade that. It's really difficult to catch this volatility, but that's why I emphasize swing trading. It gives you such an advantage to be able to just sit back on the sidelines, wait out the volatility, and then just look at the technicals and the trend over the long run. There's no point in trying to stress yourself out over the small moves. It's better to look for the potential to capture all of the big ones so that you know that you are getting all of this and all of this. So now it's time for all of this. So right now I've established a very early channel that I've seen developing based on some previous bottoms and also based on the slope of our previous moves. So I'm estimating that roughly, just based on how this channel stacks up to the previous channel that we had, I'm expecting this one to be a little bit more shallow, but this one is nevertheless very similar to the previous channel that we had on our last little bear market rally. So This is pretty roughly where I expect us to trade in the range of for the duration of the next couple of months. Now, we're still in an early chop period, so that's one thing I want people to be very careful of, is that we may have a big surge to the top of this channel. That's a signal to take profit, and pay attention to the MACD and the RSI, because there will be those moments where you'll see like this style of move, like what happened here where the RSI just peaks really quickly. Those are moments to take some profit off the table and then wait for another entry. The old adage that the trend is your friend will work to your favor, but when you see volatility that works out like that in your favor, and it happens like almost instantaneously, take that money off the table. Do it quickly, and then just hang back and wait for re-entry. Drop down to smaller time frames. Stop looking at the daily and switch down to start looking at hourly, 15-minute, and maybe even the 5-minute. I don't know. But look on multiple time frames and look for those take profit levels. Look at where the volatility is and take profit when the volatility is at its highest. These bear market rallies are going to whipsaw us around, but the idea here is that we are going to go for at least a little bit of a run for the time being. I do expect there to be a lot of jaggedness in the charts as we move up into this holiday rally. We might come up, come back down, and then just like glide along the bottom of this channel. We don't know. We're just going to have to wait and see and trade the chart that's in front of us. For the time being, I would like everybody to just be cautiously optimistic as we go into this next week's session of trading, and focus on trading the charts in front of you and looking at new indicators and looking at things through a new lens while we try to figure out a new roadmap for this market ahead of us. I do want to make mention that, like you see, the news is quite mixed over here, and this is creating a lot of uncertainty in the market despite all of this. Now, the technicals say that we have to go on a bull run, but there's a lot of mixed messages that are going to try and confuse us. For instance, we've had Oppenheimer cutting their S&P target for the year, and at the same time, Morgan Stanley is saying that the inflation bull trap will drive us all the way back up to 4,000 on the S&P or 400 on the SPY index, while possible is a really lofty target. So things are getting really confusing, and the market is upset beyond belief. So we're going to have to keep a really close eye every single day as we go into these next trading sessions. But at least for the near term, we're expecting the market to have a bigger turnaround. So now that we have broken out of this bearish channel, this downward defensive channel that we have been trading in for the last 2 months now, we're now at our first breakout on a big bullish hammer candle. So we're pretty reasonably confident seeing the market turn around to the upside. Let's go ahead and switch over to some individual stocks and see what we have on target for our next big moves. Moving briefly over to earnings whispers, just for a second, I want to point out a big focus on the financial industry. So a lot of things like Bank of Hawaii, Bank of Marine, Dynex Capital, Community Bank Systems, HBT Financial, Kirby Corp, HDFC Bank. There's a whole bunch of banks that are all doing their earnings right now. This is the big first push in the market. Banks and finance are going to be one of the big movers in the sector, at least for this rally. This seems to be a consistent pattern that we've seen going all the way back to the 2008 crash that led us into the great financial crisis. Drawing from a classic example of one of the biggest banks that was on Wall Street, I want to point out that their Q3 earnings that came in September of that year were absolutely immaculate. Things just exploded for them. They paid out a huge dividend, along with all the other major banks on Wall Street, but I'm picking on JP Morgan because I don't like them much. Banks like Bank of America, Wells Fargo, all paid a very large dividend for that year. They actually upped their dividends in the summer of 2007 and paid larger dividends throughout the year, and you can see that ever since that point in 2007, JP Morgan traded pretty much in this expanding megaphone pattern, with a flat top and a large expanding bottom. Now this ended up expanding all the way out into 2009, which led to them trading to their lowest session in more than 10 years. So JP Morgan was one of those examples of a large financial institution that was trying to prop up its stock with excellent earnings and a really, really bullish narrative that nothing can go wrong. And this ended up biting the banks in in the back end once we got into the fall of 2008. Now, our market is not quite on track the same way as 2008 was. We're already in Q3. We're already in the fall session. But that fact still remains that Q3 tends to be very good to the banks. Bank of America, 2008, in September, right around the same time as JP Morgan, they announced their earnings and things just went ballistic to the upside. They had this big scare and a big gap down because of problems with their merger with Morgan Stanley, who was honestly suffering from some pretty huge losses of their own. Bank of America surged, and right after earnings, that's when things just absolutely took a dive. So I will point out that earnings will be more than likely very good to all the banks. As of recent, Bank of America and JP Morgan reported absolutely stellar earnings, and you can even see that right now Bank of America is up 33 cents after hours today after an already really good open to their week. And their earnings, they outperformed by 4% expectation. So Bank of America and JP Morgan did really well. The expectation is that for all the banks to continue doing this. And big shout out to Hell's Trading Floor for those of you in the denizens, hellions, and demons that were taking advantage of the play and captured that huge move to the upside on that earnings announcement this morning. So moving on to other individual plays, we got our big tech heavy hitters, and we can see that Apple was one of the more steady movers that went from 140 this morning all the way up to 143. They had a huge open and then retraced by about 50% from their previous day's close, and then rebounded and started trading even further up. I want to point out that this entire pattern, at least over the last several trading hours, Apple is forming an ascending wedge, which is looking in the near term quite bearish. And this is also shaping up very similarly with Tesla, although you could argue that based on pre-market and aftermarket session, the appearance of Tesla is that it's forming a cup and handle, with the handle almost fully formed and filled out. NVIDIA also putting out a very large, very obvious ascending wedge, which is again quite a bearish pattern. So I would say be really careful with tomorrow's open, but we do seem to be breaking all of these patterns, and the RSI is continuously pushing and pushing and pushing on all of these stocks. So tech sector, heavy retail, online retail, and consumer durables, especially in the EV sector, are all pushing simultaneously. What's also really confusing about this at the same time is that energy also did quite well, though not as well as the rest of the sectors, most likely because energy is seen as more of a defensive and stable consumer sector, whereas all of the others in tech services, electronic technology, health and finance are considered a lot more aggressive, risk-on sectors. So the market is considerably more risk-on than it was last week, let me tell you. So we're starting to see that shift in momentum, and that chop is driving all of these different stocks to the upside. For tomorrow's earnings, we have some really interesting mix of different stocks. First, I want to point out a very heavy focus on consumer durables, logistics, metals and materials or producers, and energy, as well as defensives. There's a lot of defensive stocks that are going to be reporting their earnings here for the next 24 hours. Specifically in the morning, we've got pretty much 90% of all of these reporting companies are all in the defensive sector. One in particular that I'm paying very close attention to is Pulte Group. This is a home builder that I've been watching for a significant length of time and is part of the Nails ETF that you may remember I was shorting before earlier on this year, and we did very well on. There's a few other banks and SAP that's all mixed in with all of this. We're going to be paying close attention to all the big hitters in this, but I expect there to be some pretty serious volatility in mainly housing, energy, and producer manufacturers. That evening, we're going to be having reports from Google, Microsoft, Visa, Chipotle, Spotify, Texas Instruments, F5 Networks, and a whole mix of other tech sector stocks that are probably going to be pushing the risk-on sector late in the evening tomorrow. So there's a big mix of things going on in the market first thing tomorrow morning. And since we see that it's mostly in the defensive sector, I'm estimating that if we see some really bad earnings early on in the morning, that we will see a bigger push for the risk-on sector as things seem to be slowing down in all of the defensive stocks. And with the market starting to show signs of a rally, we may get a little bit of a push early on. However, if those defensive sector earnings do start to look really good, or if we get some mixed results, then we may not see that push until later on in the evening when we start to see everybody filing in to get in line for the big earnings on all of the major tech sector stocks. One thing that I did take note of was the put-call ratio started climbing very rapidly just today. We had the put-call ratio on the S&P shoot up extremely high, and the higher that this number goes, this is actually representative of the number of puts versus calls. The higher the number goes, the more puts there are, the less the number is, the more calls there are versus puts. And the way that this chart is laying out, it shows that there's a significant amount of put buying that's happening throughout today, or throughout Friday. There was a lot of fear. Now we still have to wait to see how this chart shakes out going out for the rest of the week. But this could just be an opportunity as the market moves up for the bears to keep loading up. So just like everybody else that's in the market looking for their next trade, we should also be looking ahead for the possibility of a big market dump that comes unexpectedly. I'll, of course, be keeping everybody up to date as often as I can so that we can spot where we think the top will end up being. We never expect to get it perfectly, but all we expect to do is to capture the majority of the moves and the major trend changes, and we want to be honest with ourselves whenever there is a big reversal, and when we are wrong, we want to make sure that we are cutting our losses, get out of the trade, and get on the right side of the trade in a hurry so that we can capture those moves. Wrapping things up, I continue to expect to see the IWM, that's the Russell 2000, the NASDAQ and Qs, and the SPX and the SPY to continue to push throughout the early half of this week. Tuesday and Wednesday at the latest, I expect there to be some form of a pullback. There needs to be some kind of pullback in order to confirm our support, so be ready for that. This was a really explosive move early on this morning, and we didn't see much until after hours, so we are still waiting to see what the market is going to do in the late trading session of the evening, but I will be checking out things early in the morning to see how the market fares on the Pacific Open, and I will adjust my strategy accordingly once we get through all those early morning sessions to see how we'll do tomorrow. So that's all I've got for you guys in this video. Be sure to leave a like on the video if you like the content, and if you find this information to be helpful to you, it helps out the YouTube algorithm and gets this information to people who need it. And if you are not a member of Hell's Trading Floor, I strongly urge you to consider it. We're a very friendly and welcoming trading community that's most interested in helping you become a profitable trader, teaching you how to capture the big moves. Thank you so much for watching. I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.